we just heard banking analyst Chris Whalen say those European bank stress tests don't tell us much. Does Mark Dow agree? Dow's a portfolio manager at Pharo Management and a former economist at the IMF and the Treasury Department. Mark, thanks for your time. Tough talk aside, whether it was tough enough or not, the goal here is what? To restore confidence to the banking system, something that we can't necessarily know today.
That's right. This is a process. It has to be looked at as such. They came out with a stabilization package about 6 weeks ago. They're taking fiscal measures to reinstate confidence at that level, and now they're coming out with greater transparency in the banking sector. Is the situation good? No. Is it better than it was on Friday? Yes. We're going to slowly but surely get more transparency and more confidence.
But what about all this focus on whether it was tough or not? If you were hiring somebody who had an A grade from Harvard versus a state college, you would say, okay, but you wouldn't go to the schools and try to figure out what tests they took and how they did there. You would make a gut call, would you not?
Yeah, but I think the bigger picture is not the state of things today, but are they getting better or not? And slowly but surely they are. There's a long way to go before they fix their problems, but they're on the right path, and it's a process.
Here's what we know now. Some of the sovereign bond exposure that individual banks have, HSBC, Barclays, all these players. That's something we didn't have before. Is it enough for analysts to at least start to try and crunch the numbers on who's most exposed and then maybe calm the rest of the market that way?
Well, it's never enough when it comes to information when things are under stress, but we're narrowing the uncertainty, and that's part of the process.
Are there potentially more skeletons in the closet? I think that's the ultimate question that people would have if they think these tests weren't tough enough.
I think this is somewhat analogous to the talk that we heard after the stress test for the U.S. was released. There were a lot of people skeptical about whether or not it was sufficiently stringent, whether or not the numbers would hold up, whether or not more skeletons would come out of the closet. But ultimately, it reduced the uncertainty to a point where it facilitated the recapitalization of the banking sector.
At the same time, we can't do a direct comparison between the U.S. stress tests and the European, right? Because we were talking about the mortgage market here in the United States as opposed to the debt of individual countries in Europe.
That's right. The particulars are very different on many different levels, but the psychology is similar. The markets tend to be skeptical until we get beaten over the head with information to the contrary, and I think we're a little bit in that process. I'm not saying that things are good in Europe.
Right.
I'm just saying they've embarked upon a process. It's going to be a long one, it's going to be a slow one, and it's going to be a painful one, but they're going in the right direction and things are getting better.
Going back to whether the tests are tough enough, are they tough enough for that worst case scenario? So well, let's talk about a worst case scenario. What would it take, economies, et cetera, to get to one of those worst case scenarios in the first place?
Well, as we saw in the U.S., that we did not get anywhere close to that scenario, right? And it's probably going to be true in Europe. And one thing you need to take into account, when the U.S. had its stress test, we were saying, how bad is it going to get? Because we were in a downswing. We've been in an upswing for the global economy, right?
Yes.
And so the switch in the GDP forecasts from where they are now to what they might be is equally stringent, I think. And some of the haircuts in certain countries are fairly aggressive as well, particularly the problem countries, Spain and Ireland.
You might say the market reaction has been mixed to this story, but a bigger question is whether we should be looking at what's happening in the markets or whether we should look at the relationship between banks. Because at the end of the day, it's whether or not those banks are confident to lend to each other and avoiding a situation like what we saw here in the United States.
The signs of things are getting better. If you want to go back to last month, you can see that the thaw actually began in June, around the second week, when the euro hit a bottom just below 120 and started to bounce. Over the course of the month, you saw spreads and Greek bonds and Spanish bonds start to stabilize and then narrow. So we already began that thawing process before these results were released. My guess is we're going to continue along that path. It's going to be bumpy, it's going to be difficult, but we're on that path.
Okay. As for the outlook for the U.S. economy very quickly, how is it affected by all this, you think?
I don't think it gets dramatically affected unless we somehow spin back into systemic risk. So as long as things are on an even keel, it's not a problem for us and we'll be left to our own devices.